Let's walk through this money press on JPM. Look, in the updates that I send out today, we'll be dealing with each one, and I'll try to make some more comments on each one. And what Mike here in the land office keeps telling me is, you got to send out some more videos, and I'll do. I should do it. Okay, I should do it. Anyway, here's what we'll do with the stock. Now, is the stock different than when I froze this option chain? Yeah, it's going to be different if you go look at quotes, live quotes. But I've got to freeze it here so we can look at it. And what was I saying? I got to keep it in pen mode here. What's the high of the day, Ben, Mike?
139.
139. Okay. This would be are the 139 puts only? Anyway, there's not that much premium in here. And that's another thing that the 3-day rule kind of can settle down. On days when there's just suddenness, okay, the options on both the call and put side across multiple strike prices and expirations, they're going to get that jolt too. And so sometimes too, part of that 3-day rule is not only does the stock kind of, okay, this is the new reality, and we just see where, the investing conglomerate of thinking goes, but also the options, we get to maybe see a little truer picture of, okay, here's what those week-to-week options look like. So there's just a couple reasons for it. Okay, so all that said, what a money press construction could look like is, first we're going to sell weeklies, and then we're going to buy protection, and that's out in time. We're really time merchants when you would boil it all down. We're wheeling and dealing in time, and we're going to sell the weekly time, and in this case, if the stock's at 138 and change, I'd be very comfortable, especially with a brand new surprise factor, blah, 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 of selling the weeklies, but the 139 puts, okay, which happen at this particular point in time to have a premium. Now, they're always listed in a bid ask, okay, and that's because there's buyers and sellers. And if you were wheeling and dealing and wanted to buy next week's 139 puts, the price they have for you is closer to this 195. So you'd want to try to buy it a little bit lower than that. Well, for us, we're looking to sell the weeklies. So our price is 190 right here. And then if we wanted to try with a limit order to get a little bit better, to each his own, maybe a penny or two. But it looks like that bid is right there around 190. And that's for us to sell the 139, the weekly, which is right here, this April 21st. Why do they say 21st? Well, that's Friday. It's next Friday from now. And then, so this is 190. That's very close to 2. What we do as a rule of thumb is we double up this 1 week premium, which again is very close to 2. What is that? When you times 2 by 2, that's 4. And I use $4 to space the strike price of my protection. So I'm going to buy the 135 puts, and then what we're going to do together is we're going to go see what month. Now, do we have to worry about earnings announcement for JP Morgan in the next 2 weeks, 3 weeks from now? We have to worry about earnings season for JP Morgan? No, they just announced before the open. Okay, so what do we know about the next earnings? Well, this is mid-April, so May, June, July. Around mid July, they're going to announce their next earnings. Actually, July expires on the 21st. So we could do July. I mean, we could definitely start a money press with July. But if this one starts treating us well, okay, it doesn't mean that we just have to do this all the way into the third Friday of July. You know, when we start getting into May, June, and we're doing good in our money press, I'm going to flick that July out, and there's going to be more months at that time too. Right now, we have the choice between July or September. Okay, and I think we can get our money press started just fine in July to get this thing going. But my whole point is, it's not hard and fast. We don't have to stay stuck in July. We can adjust that anytime we want. But right now, if we go out and look at the July 135 puts, those cost, or July 135, we're going to be a buyer of those, and they want to charge us about $5 for those. And you can look at that and say, well, that's not a good deal. We're buying something for $5 and we're selling something for $1.90. That sounds like the suckiest strategy in history. What are we doing? By the way, when you enter a money press, the option terminology is this is going to be a debit. When you start a money press, it's a debit spread. Well, how do you make any money on a debit spread? You have to spend $5 and we get in basically about $2. So we're kind of -3, right, to begin. That's why they call it a debit spread. Well, what's the whole idea behind this? What are we going to be doing? Is this trade just the trade for that week? Hell no. We're doing this because we're going to turn around next Friday and we're going to be looking to sell another weekly. And then we're going to look to sell another one. And we're going to look to sell another one and another one. And if we get into early June and we're selling enough of these, we're going to look at that July and we're going to flick our protection out to September. And we're going to do selling weeklies and weeklies and weeklies and weeklies. And we have an edge and odd with the JPM if the stock turns out to hold this ground, if not move higher. And that's kind of the whole idea. And we were over our time, but that's how I would choose the strike price to sell and the strike price to buy and what month to buy.